There, it's Michael from B Ninjas. I want to talk to you today about cash accounting versus accrual accounting, which are two different ways of accounting for the transactions in your business. So, I've done a quick table to explain you the difference. Let's start with cash. You record a transaction in your business when cash leaves or arrives in your bank account. It's pretty simple. It's just recording the cash movement itself. For businesses just launching or starting, you're a sole trader, owner operator, you might just be using that method of accounting to begin. It's obviously the simplest and it makes the most sense to most business owners just getting started. You might see some large fluctuations in your cash balance. For example, if you're receiving, 25K for a big job you've quoted on, that looks like you've had a great September, but then you might have a lean October, November because no extra cash is coming in the door. So there might be big spikes in your profit and loss when you're comparing month on month. It's usually for businesses just beginning. And then as you grow and you might want to engage in a bookkeeper or an accountant to help you, you'll move into accrual accounting, which is industry best practice. And it's more based on when an invoice is sent or when you've performed the work. So it's more looking at when the money was truly earned. And so if you've earned that job, that 25K job, over the next 3 months, you'll recognize a portion of that over the following 3 months, which smooths out your cash flows. So it's for more established businesses normally who have the resources to help pay for that. Most businesses just getting started in Xero will be cash coding from their bank reconciliation screen, and that is what will be used to construct their profit and loss. More established ones will possibly be booking some journals at the end of the month to truly show when the labor was used to perform on that job and how much was received. And that helps you with job profitability as well. You get to actually see with a more accurate layer what actually happened in September and how profitable were we for this month, rather than just having 25K in September and then a wage cost for the next 3 months. So it looks like October, November were terrible because there was no revenue and you made a loss. So it's trying to pair the revenue and the expenses together in the periods that they were actually earned and received. And then that way you get a more accurate picture of how the business is going. So it helps smooth it, and it's much better for a longer term view of how the business is going. So industry best practice is accrual, cash usually for people just getting started. And you can toggle when you run a profit and loss in Xero, you can toggle between cash and accrual reporting in the little options pane. So you can actually toggle between them. So run that in your Xero and have a look and see what the differences are between that. Great. Thanks for watching.